Avery. So thank you for being here. Appreciate it. We're calling this show Buy the Ugly House.
I like it.
Yeah. So the whole idea, behind this and, why I want to do this is we were talking about it earlier, but I want to build an ecosystem of people that like you and I would want to work with. And I want to put out education and like just basically teach people about kind of, the investing world and find our tribe essentially. So I wanted to have you come in and talk today about what you do. You are a hard money lender. I borrow money from you all the time. I think I owe you just a little bit over $1 million.
Just over $1 million. Yeah.
But yeah, can you just tell us kind of, who you are, what you do day to day?
Yeah, absolutely. So yeah, thanks, Adam. Happy to be here. And I love that topic, right? I love educating. I think investing, a lot of people are interested in it, but they feel like there's a big barrier of entry. And I love to break that down and make it very simple. And so, yeah, like you said, I'm Avery Robertson. I run J&R Capital. So we're a hard money lending company. So we just do short-term real estate secure loans. You see people like Adam buying those ugly houses, and you see people saying, hey, we'll buy your house with cash and do those things. Some people truly are out there buying with cash, but I would say a lot of them are using private funds or hard money loans. And so instead of banks don't like to really lend on these ugly houses, banks take a long time and it's tedious. And so a hard money lender can look at that asset and see that business plan and the value in the property itself, and then once it's fixed up and make a loan that way in a lot shorter time period.
Yeah, and that's what I love about working with you. I've literally called you and said, hey, like I need to close on this in like 6 days. And you're like, cool,
let's
done.
do it.
Yeah.
Yeah, very common time period for us, to get things done in a week or two. It's, I move that fast often.
Yeah. Yeah, I don't want to set you up and now everybody thinks that like, yeah, one day he's got you.
Yeah, for sure, for sure.
Give him a couple weeks if you can. And you kind of have a unique perspective on this because you are also a real estate agent. Is that correct? Did you start out as a realtor or as a lender?
Yeah, good question. I started out as a lender, and with a hard money loan, I'm not worried necessarily about your credit as much. I'm not really worried about your income or your job, your taxes, but I am worried about the value of that asset and that you can execute on your plan. And so a big thing about that is figuring out what is the value of that property. So when we first got started, I wasn't licensed, and we were bugging all my realtor friends all the time, like, can you give me comps? Can you give me comps?
Got it.
Like,
yeah.
And you're busy with your clients that are actually paying you. It was, great realtor friends that helped us out, but we needed to move faster. And that's why, as I scaled, it just made sense to get my license.
Got it. Yeah. Something about the Idaho real estate market is we're what's called a non-disclosure state. And so the sold prices of properties are not public knowledge. You can't, like Zillow can't see what house is actually sold for, which is why like Zillow estimates are so inaccurate here. In order to get that market data, you have to go through a real estate agent. So that makes a lot of sense. If I'm asking you for money, you're not going to want me to run the comps on my, and tell you what I think it's worth. Like you want to be able to verify that and come to your own conclusion.
Yeah, absolutely. And, we would, I like to hear what your plan is, what you think comps are, but I definitely want to do that independent due diligence as well. And I remember one of my first loans, like he sent us comps is in the Boise market, and, he was thinking ARV like 400,000 or something. And as I got my own comps and kind of looked at those closer, like that neighborhood itself was probably selling closer to, 360. And so I was able to share that data with him, and he was able to kind of change his plan and renegotiate and things too. But so it's definitely, yeah, you want, it's an important part for the flipper too. You want to make sure you have your comps and your value right. And then obviously as a lender as well.
Yeah. Yeah. And it's a collaborative effort sometimes. It's like, hey, maybe I've got the rose-colored glasses on and I really want to do this deal for this, that, or the other reason. But like, you have to look at it objectively.
For sure. And we used a software called PropStream for a little while. And I know a lot of investors are still use it, and there's a lot of value in it. But they did profess to kind of show you, it wasn't the exact sold price, but something pretty close to it. And it was accurate, maybe 70% of the time, but as I checked that against actual comps, it just wasn't reliable. So yeah, I had to get the source data from the MLS.
Nice. So you became licensed specifically to be able to pull up accurate
I
sold
did.
data.
Yep.
Nice.
Yep.
Hey, that works. Like I think that it's obviously paid off for you.
For sure. It's definitely been worth it. And then, I do some sales for myself and for some clients, but definitely the focus is on the hard money.
That's cool. I've got some questions here for you. This is a good one. What is the biggest misconception people have about hard money?
Yeah, I think, I think hard money can scare a lot of people. It is high cost, right? We were just talking about how, the loans aren't cheap.
No,
they're not. They're meant to be short term, right?
It's worth it, but dang.
Yeah, it's like we just do investment properties, right? Like you don't want this for your house, right? Because you're just eating up equity. But in for an investment, you're truly leveraging this money to make a profit, right? So even if you're paying me, say 14% interest and some fees, you're using that to leverage and create value that gives a profit, hopefully, if everything goes right.
Yes. It's all about speed.
Yep, exactly. And so I think a common misconception is that is just that fear around it, that it's a loan to own, we're loan sharks, and you're just like, it's a high risk loan. And, I would say there's definitely out there, I would be wary of who you work with. But
sure.
I think knowing like a local lender like myself, that I am in the business of lending money, right? Don't want to take over the properties. I want you to be successful, and I want to lend you money again, right? We want to continue to do this. And so I think that's a big misconception. And I see out there, people looking for that 100% financing, and I see lenders maybe advertise 100% financing or very high leverage. You might find that from your uncle Tommy or whoever, but a true like hard money lender, that would be very difficult to find. So I would tread very cautiously. And there's a lot of maybe scams out there.
There's gonna be a catch.
For sure.
Yeah, there's gonna be some fine print that you don't like.
Yep.
And so I've looked into tons of hard money. Obviously there's a lot of like companies and different people and whatever that out there that do what you do.
Sure.
I just keep coming back to you for several reasons. But yeah, you'll see an advertisement for 100% financing, and then you actually get on the phone with the company and they walk that back so quickly. It's like, it's a gimmick. It's not,
to get you in the door and get an application. And
And I think it's important to have a little bit of skin in the game.
I think so.
If I'm buying a property and like I've got my own cash in the deal, it's just that little bit extra motivation. Right?
Yeah, it gets you motivated. I want to protect that investment. And as a lender, I like to see that. I want to see that skin in the game that, we're both invested in here. And something I talk about a lot is you're, as a house flipper, you're taking an equity risk, right? You're putting that your skin in the game, and you're hoping for an equity size return. So essentially, by taking that higher risk as flipping the house, you're expecting to get this really good return. And as a lender, like I get a good return, but like it should be on average less than like your return, right? Because I'm taking a debt risk. I am at a lower risk position. You have skin in the game. have a lien on the property. So I think that's just something to keep in mind. Like make sure you're kind of matching up your return to your risk.
Got it. Yeah, that makes a lot of sense. I've had deals go really well. I've got one right now that's going really poorly. And it's kind of a lesson learned. But yeah, I mean, that you definitely are. Like if you're looking for hard money to flip a house, you need to be very careful and make sure, if you've never done it before, that you're getting some really good advice, preferably working with somebody that does this all the time, right? Because you are taking this huge risk buying something that like, yes, you're probably getting a good deal on the house, but you have to make sure it's going to be worth enough to pay for all that, right? And reward you for that risk that you took. Like it's, there's big margins here. There's a lot at stake.
Yeah, absolutely. And I think a lot of people, if they're new to the game, they hear, hey, so-and-so bought this house for $200,000. They sold it for $300,000. they made a killing. It's like,
Right. Yeah.
I mean, one thing is just like, oh yeah, obviously it costs money to fix it up, but there's a lot more expenses that go into that. Like you're going to pay your commissions and closing costs when you sell it. You're going to pay some fees when you buy it. You're going to have taxes and insurance while you hold it. And, there's a lot of things going in there that you really have to make sure you run those numbers properly.
Yes. Closing costs on both sides. You usually end up paying a buyer's agent to sell it for you. There's all of these things people don't think about.
Yep.
If you're selling a house for $100K more than you bought it for, you might only be bringing home 20 grand,
yep.
which is still a great payday, right?
Yeah.
Who doesn't want to make an extra
Right.
20 grand this month? But it's not as like, there's more to it than you think.
Absolutely. Yeah.
Awesome. Okay. And here's another question I definitely want to ask you, because, as I said, like our whole goal is to kind of like find our people. Right. And like, so I want to know what kind of investor or buyer is the best fit for this type of loan and for you in particular. Who are you looking for to work with?
Yeah. Really anyone in the real estate investment space. So a lot of my clients are doing those fix and flip homes like yourself. So someone that is ready to go. I've worked from new people to experienced investors, and so if they have a good plan and have some access to capital for the down payment, for the rehab, if we're not financing that, then there's, that's who I want to work with. And also, like, I work with a lot of people too that for whatever reason just need like a bridge loan, or a bridge loan is just like a short term loan. For example, I had someone buying some development land up in Rexburg, and I want to say he was buying it for like $1 million. And he had a long due diligence period. And during that period, he had put a lot of earnest money down. So I think he had already put down $600,000 to $700,000 kind of as he was doing some of the due diligence.
A lot of cash.
And entitlement. Yeah, a lot of cash. And he actually had done like a hard money loan with some of his money that was supposed to pay back, and it didn't pay back in time. So he needed to close at this point. He didn't want to lose his $700,000. And so I was able to come in, give him $300,000, whatever it was he needed, and just bridge that gap so he could buy it. And then he would have some funds coming back that would pay me off, and he finishes the development of that land.
Nice. So yeah, you saved his ass on
yeah
a really big deal.
Exactly. for sure. And so it was worth it to him to pay those fees and keep it, and obviously work on collecting his loan.
Yeah. Well, I mean, yeah, you're providing a super valuable service to this industry. We're lucky to have you.
Well, yeah, no, I love this industry, and anyone, if it's real estate secured loans and investment property, that's something I would look at.
Cool. All right. So while I've got you here, definitely want to get like really tactical and specific. I want to provide some value to the people. And I want people to walk away from this, like actually really knowing more about how these investments work. So the first question I want to ask you is, why don't a lot of ugly houses qualify for traditional loans, for bank loans?
Yeah, that's a good question. And a lot of times the banks are just it's outside of their box. They don't like these properties that need to be fixed up, because the banks are just very conservative, right? And if they see this property needs to get fixed up, they're going to want a very large down payment. And if they're just thinking, if I take this property back, like, what am I going to be able to do with this? And it's just outside of what they're doing every day and their regulations. Well, like a hard money lender, I can see that, and I understand that investing market, that I can say, if I had to take this back, like, I know there's value there and there's a margin there that someone else could just flip it. I could get it sold. And I think you might be able to find some like local community banks that would finance some of these ugly houses, but they're going to want very big down payment, and their underwriting is going to take a month or so. So I really would say that's the biggest part.
And you're typically looking for 15% down, correct?
That's correct.
From the investor.
I would say 15 to 25, kind of depending on the strength of the deal, location of the deal, and the experience of the investor. But yeah, in that ballpark, 15 to 25, I would say is often somewhere I would do. And oftentimes I'm structuring that loan too, that you put your down payment. So let's use that 15% example. So you buy a house for 100,000, I give you 85,000. At closing, you're coming up with the 15,000 plus closing costs and fees, and then you're bringing in the money to fix it up as well. And that could be a partner, could be your own capital. There's lots of sources for that. Could be a second lien holder. Maybe you've got a family member or friend that is willing to lend you that money behind my loan.
Yeah, I really appreciate that you are willing to let me use second lien holders in some cases, because some hard money guys won't do that.
Yeah.
And I do a lot of deals.
Sure.
And so, yeah, I like to bring in other money and put other people's money to work alongside mine and stuff. So yeah,
makes your money go further, get them a return. And
I mentioned there's several reasons why I keep coming back to you. That is one of them. So
yeah. I'm doing not to sidetrack, but I'm doing a deal right now where it's a new construction loan. He's building a commercial building, and he's buying the land, and the seller is actually going to subordinate that land. So essentially, the seller is going to seller finance the land. So the seller's selling him the land for, let's just call it $200,000, but he's not going to get paid right away. He's going to seller finance that, so he's going to get paid it at the end, just like he's going to be the bank for him, but he's going to subordinate. So he's going to be in a second lien position. That allows me to come in and finance the construction, and I have a first lien position in the land. And the borrowers put some down money into it as well. But it allows me to have a pretty safe loan because, if crap hit the fan, and I had to foreclose, like I have the first right, that's what that first lien means, to foreclose on that property and recover my investment. That seller, would be behind me. He would have to essentially pay off my lien to recover his. But he's willing to do that because he sees the value in it and trusts the plan. And whatever his reasons are, he's willing to do that. And it allows me to do it too. But it reduces how much cash the borrower has to come up with.
Awesome. Yeah, we may need to talk about something like that, because I ended up kind of with a free lot. Yeah. Out of one of the deals that you financed for me, right? Like, it's bought the house and then found out that, like, hey, like the yard of this house is big enough to just split off, and I can still sell the house for more than I paid for it. And then I've just got this free piece of land out of it so we're probably gonna build a duplex on it.
Awesome.
But yeah, it's fun. Like, I talk a lot about creative finance and just like creatively kind of like making things happen in different ways. And so it's fun to like brainstorm with you about like deal structure and using gap financing here and just different ways to like make things work. There's always a way.
Sure. Yeah. It's, there's definitely, it's good to get creative and figure things out. And, you have to be able to think outside of that traditional box. People think either I have to have cash or I have to be able to go to the bank. And a lot of times, like kind of going back to why not the bank? A lot of times when you're buying these ugly houses, the seller just wants to get that good price on it. They want a cash transaction or similar to cash, which, hard money can act as, to close quickly and there's not like the appraisal contingency and all these other contingencies that might drag out a normal transaction. Yes.
Yeah, that's huge. So when I write an offer using hard money on the purchase and sale agreement, I'm paying cash because I can close. It's not my cash, but it's cash. We're doing this deal with cash. Yeah. We're waiving inspection, we're waiving appraisal, we really can close within a few days, a week, whatever. But yeah, that speed is absolutely essential. And it's part of why we're able to get houses at a discount. Sometimes there truly is an emergency situation. The seller has to sell right now. Maybe they're about to get foreclosed on next week, and they waited till the absolute last second and realized, hey, if I don't do something right now, I'm going to lose everything, right? And we're able to come in and actually get them some cash in their pocket.
Yeah, you solve a problem. A lot of people say, oh my, how could you get a house that cheap? Or, are you ripping someone off? But you're providing a solution. There's a time and a place for this. Someone that has time and a house in good condition and can sell it in the marketplace, they should go get that top dollar. But to go out there and say, you can get me out of this problem, whether that be foreclosure, whatever that problem may be, bad tenants, some kind of stress. Yeah. You can come in and solve that problem.
Yeah. And I'm a listing agent too. So I've told people not to sell me their houses.
Sure.
It was like, hey, like if I buy this house from you, this is what I can give you because I need to make this much money on it. And that's how it works. If you let me list this for you, I can pull you this much and you're going to make way more even after paying my commission.
Yeah. That's a great tool.
Depends on the deal.
yeah, you can come in here and say, here's a couple of solutions for you and what works best for them.
Yeah. Yeah. 100%. So what do you look at first when somebody brings you a deal?
Yeah, I'm looking. So I analyze a deal just like if I was going to flip it myself. And so there's a term that, a lot of you are probably familiar with, ARV, so after repair value. And that's kind of why we want to pull comps on. We want to see, what is this house going to be worth, after it's fixed up, listed on the market. And then you work backwards from there. What's your hard money cost, your closing cost, your other holding cost, how much does it cost to fix it up, and then what are you buying for it? And I see, is there a profit there? Like, do I feel, based on the comps and this plan and the scope of work, do I feel like there's a profit there? And if that's the case, then usually it's a go for me, as long as we can get that down payment or that value where we need to be. And typically there's kind of two things I look at on that side. So like, first, like I said, I want to see that you have that successful plan, that there is a likelihood of having a profit for yourself. And then my total loan amount, I want to be at 65% or less of that ARV. And so if ARV is 100,000, I want to be $65,000 or less. And then a lot of times I am less than that, just because I do want that skin in the game. I want that, say, 15% down, 20% down, whatever that may be.
Yeah. So that you're not taking all of the financial risk. That investor has to be.
Yeah, exactly.
If they get a free house, what did they lose if the deal goes sideways?
Yeah, for sure.
Because you paid for the whole thing.
Yeah, I paid for the whole thing.
Why aren't you just buying it yourself at that point?
Yeah, exactly. I've had people like bring me deals and say, hey, if you give me all the financing for this, I'll give you a little cut of the deal or something. It's like, what are you bringing to the table? It's like, yeah, sure. Like, sometimes there truly is a time where, like, you just found a killer deal that you can go out and pitch that to someone, like, bring me the money, this is a killer deal. But for a hard money lender like myself, like, it's, let me see your skin, and maybe you can go out and find that partner if you do need some extra capital and figure out something with them.
Yeah, at that point, it's like, yeah, let me give you a $5,000 finder's fee and I'll flip the house myself.
Yeah.
Like, what are you what value are you providing in this scenario? Yeah, that's really good. And so you kind of got into the numbers there. So you want to see, you want like essentially 35% equity, right? You want to be in for no more than 65% ARV.
Yep.
And then like what's your allowance for like the renovation budget in that kind of equation?
Yeah. I don't have like a strict requirements on that. Like, I want to see that that renovation budget just kind of makes sense. Like, I've done some projects that are really big scope, had fire damage and things, and they're bigger renovation projects. Right now, a lot of the loans, like I talked about earlier, I am just financing that portion of the purchase price, and we're not doing any monthly payments. I think that's how we've structured most of our deals, if not all of them. And so then that helps you keep the capital to fix it up and get it sold. You're not having to make that interest payment.
Yes.
On occasion, I will finance, have you put a down payment, say 20+%, and I'll finance the rehab in draws. So like, as you get the work done, I will give you some of that money from that loan for the rehab. And in those situations, like recently I did a loan, and kind of what brought this up is the house was in Idaho, and it needed quite a bit of work. I think, the rehab budget was, I think, bigger than the purchase price, or close to it. They might have been equal. I think he was buying the house for, say, $80,000 or something, And it was probably $85,000 he had to put into it. And so like, on something like that, like, I know this is gonna be a longer term, like, what I ended up doing is, I financed, I think it was maybe 65 to 70% of the purchase price. So he put, a good little chunk down, but then I'm financing all the rehab, and we'll do that in draws, which mitigates my risk, because then I know work is getting done. And on a loan like that, he is like making an interest payment too, just with larger amount and longer term.
Got it. Yeah. That's because the flip side of that coin is like, the more equity you have, there's probably a reason for that, and the reason is it needs more work, right? Like, the bigger of a discount you're getting on the house, there's also, it's going to take a lot more capital to get it up to that ARV.
Yeah, I would say offsets. Most of the time that's probably the case. You're buying this at a big discount, but there's going to be a lot of money, and which could mean more surprises too in
Yes.
the budget. So you would want a pretty healthy margin on a project like that, which this one does.
Nice. That's cool. Last question on kind of this tactical segment. What's something investors overlook when they first use hard money?
Yeah, it's a good question. What do they first overlook? I mean, I think a common thing, and I kind of touched on this earlier, that I see like new investors coming to me is just not running all those numbers closely on their, like, those holding and closing costs. Like, what is this truly going to cost to fix up outside of your budget? And then also, you know, I've had people come to me, and I'm happy to work with new investors and you know, share the comps I'm looking at and my thoughts. Like, they need to be able to make that decision for themselves, right? I'm not deciding if they should do the deal or not. I'm deciding if I'll do it or not. But I see them come to me like wanting to do a deal, and I say, "What do you think the ARV is?" And they're like, "Oh, I don't know yet." And I mean, that's just rolling the dice. So,
yeah.
It's like, I'm going to buy this, throw some money at it, and we'll see what it sells for. You know, what if it's worth today, like, you know, 20 grand more than you're buying it for, you know, whatever.
Yeah.
Like, you need to know those numbers and do some research and feel good with that.
Yeah. Yeah. I like to underestimate what I'm going to be able to sell a house for. And I also want to be able to sell everything below market value. I want to always offer a deal. When I list a house, I want it to sell immediately because it's priced better than everything else that those buyers are looking at. So we're being conservative as possible when we're running those numbers.
Yeah. And I've seen that. I'm as a lender where I'm going to tend to be more conservative. You know, if a lot of times I might be a little bit less on my ARV than a lot of people, and I might just choose to do that because I know there's still a margin there. But I see how they could have that upside. But I mean, I've seen a lot of those deals where you send me your numbers and I'm running them. I'm like, oh yeah, that makes complete sense. And you probably have some upside on that. And that makes sense because, you know, if you're having interest debt service that is accruing behind the scenes that you're gonna have to pay, time on the market is money, right? And
yes.
So the sooner you can sell that, the more profit you're gonna make.
Yeah. The longer it takes, the less margin there is.
And we were talking before this about cutting your losses sometimes. Like, if something is not going how you plan, on just choosing to say, yeah, I'm going to take a haircut on this, but I'm just going to take my haircut now and get out. I have, you know, seen some borrowers who have done, you know, a really good job on their flip. It took them a long time to get it done. And then because they took longer, put more into it, they were like, well, I need to get this price to make my profit. And so I
get that with sellers too, man. They're like, I have to get this much for it.
Yep. But it's
a bad strategy.
What we want doesn't determine the price, right? The market determines the price. So, you know, you end up losing more money because you start up here, then it sits, and then everyone's like, well, that's been on the market for 120 days.
Let's lowball this guy.
Yeah.
Like, if it was worth what he's asking, somebody would have gave it to him.
He would have gave it. There's a problem with it. And so then it just hurts you more. So I think I understand the emotion. Like, you've put blood, sweat, and tears into this potentially, and you want to recoup that investment, but sometimes just being logical, say, I'm going to cut my losses, move on to the next deal, and keep going.
Yeah, 100%. I always try to follow the advice that I would give myself if I was one of my clients. You know, and I've got one pending right now that, like, in the back of my mind, I'm like, I could have made more money for that. I should have priced it higher. Like, it sold too fast, you know, and that's the same thing that a seller says. If you nail the listing and you get them under contract and they get the perfect result, now they're mad because you should have asked for more.
Yep.
Right. And so it's just, you never want to be greedy. Speed is the name of the game. Giving somebody a good deal, you know, that buyer is getting a good value. Like, it's something you can feel good about. And obviously, if you're willing to list it for that price, there was a time when you felt like that was enough money.
Yeah, it's very psychological. So
you got to keep the greed out of it. Yep. If it works, it works. Everybody wins. Everybody benefits.
I had a professor that would always say, and it probably took me a while to really click, but it's pigs get fed and hogs get slaughtered. So just getting fed, just getting those base hits and things is how we succeed. You know, being greedy is we get slaughtered.
Yeah, 100%. This is a singles and doubles game.
Yep.
Yeah.
And then when you get that home run, you just celebrate and take it, and then go back to getting those singles to doubles.
Yeah, so. Yeah. Swing for the singles. Don't try to retire off of one deal.
For sure.
Yeah, it's a good way to get yourself in trouble.
Yeah, absolutely.
And I'm on investor lift, so I'm always getting sent deals in like wherever, New Mexico, like just random places, and I just don't even consider it because I'm like, I know my market. Yep. There's already enough risk involved. I don't want to add risk by being in unfamiliar territory. I've got my crew, I've got the people that I trust to go and do the work correctly, and they're not going to rip me off. Like trying to you'd almost have to rebuild your entire business for one deal to do it somewhere else.
Yeah. Kind of staying in your lane, there's definitely value in doing that. So
yeah, but I mean, if we can bring other people, into this market that are
they're moving here, or like me, like most of my money is from investors, right? And so my investors can be wherever they want to be, right? So sometimes I make a connection like that. Someone's like, you know what, I don't really want to flip a house, but can I give you money to lend out? So.
Yeah. So do you, that's actually a question that I've had for you do you sort of manage a fund that you then use to allocate to investors like myself? Is that kind of how it works?
Similar, but we're not set up as a true fund. I do what we call like the direct placement or co-lending in the industry. And essentially what that means is, like, say you wanted to invest some money in a hard money loan with me. You wouldn't just give me the money and then and then I'm going out and lending it against different properties. You would tell me, hey, yeah, I want to do this. And then I find a specific deal and I underwrite it. And then once I underwrite it, I say this is the deal I'm doing. And then I send that to some of my investors. I typically, if they want me to and I have the capital, I put some money in, and then I bring in an investor or a few investors into that loan with me. And then we sign an agreement. It's called a participation agreement on the back end, which essentially just gives them that interest and that undivided interest for their percentage in that loan and those liens against that property. And then they're tied to that loan. So when that loan makes payments, when that loan pays back, then they're paid back.
Got it. Cool. So, and they're pretty happy not receiving monthly interest payments. They'd rather everything compound inside of the deal until the end.
Yeah. That's how I started my business and grew it that way. It's just here it comes at the end. And a lot of guys are, obviously they've happy with that. I've sold them on that from the beginning. I had some guys say, because every once in a while we have that monthly payment, and I have investors say, I really like the ones that just pay at the end because that month interest coming in, it just kind of disappears, maybe gets spent on something stupid or something.
Yeah.
But at the end, now you have a tangible chunk of change that let's just reinvest it, and they're snowballing it. But certainly there are other investors that say, oh, I really like that monthly interest. And so they love when those loans do that. But I definitely just say, my bread and butter is no payment. And then on occasion you'll have a payment.
Yeah. I like that model personally. Mm-hmm. Like, cause you're already, you're paying whatever, thousands of dollars a week in repairs, like all this money's going out during the deal. So to not have an additional bill on top and at the end you make more anyway, right? Cause again, the whole chunk is compounding the whole time rather than like taking pieces out and then you just get the original capital back.
And that's probably a good point for clarification too. So like in the industry, you'll hear like Dutch interest versus non-Dutch. And Dutch interest just means, so you actually, if I am like doing those draws, you actually do still pay interest on that full amount for the full time. And the reason for that is because that money is set aside with your name on it, right? Like I don't have access. I can't go spend that on something else.
Yeah. You're just holding it to the side. I'm holding it
for you. Yeah. It's ready for you as soon as you get draws done. So you do pay interest on that full amount. So,
yeah.
So that would be something to keep in mind too. If you had a construction draw type loan with hard money, most are structured that way. While a bank would do it kind of how you referred to, where just as you make those draws, like that's what you're paying interest on.
Right.
Because banks are much more well capitalized and different regulations than
pros and cons.
Yep.
Pros and cons for sure.
For sure.
But I think like the speed, the ease of use, the less cash out of pocket. For me, hard money on most deals, I would say on like 90% of deals, I would rather take hard money than bank money. Even with the extra fees and interest rates, like the pros far outweigh the cons in my opinion.
Sure. And that's what I'm always saying. It's a numbers game. If you're going to make profit, it's like then getting that quick capital that works for what you're doing. That cost is just a business expense.
Yes. Yeah. Well, and, if I'm doing like 6 to 8 projects at a time, right?
Yeah.
A bank isn't going to like that as much as you are.
Sure.
Because you're on the ground, you understand what's happening. You've looked at each one of these deals and are able to look at it from the perspective of an industry insider. Whereas an institution is all about risk levels per client and all these different things that, they're not taking into account what you and I understand about how this works.
Yeah, absolutely.
So risk, strategy, and smart decisions. How should investors plan? We've touched on this a little bit, but let's specifically address this. How should investors plan their exit strategy before borrowing?
Yeah, I think the biggest part is, and we stress this, right, is like that ARV, those comps. And sometimes if you pull comps and you see like there's a few houses that have sold for quite a bit less, and there's a few that have sold more, it's like you probably need to think through like, okay, what made those ones sell for less, this one's for more, before you just bet on getting that top of the market.
Yes.
So yeah, really knowing that strategy and say, okay, and when I've looked at flipping houses, like I think that margin, that profit expectation is really like is your safety cushion too. Because if you say, if I sell it for $300,000, I'm going to make $40,000, and that gives you essentially $40,000 to, spend a little too much on the rehab, and for the market to soften and break even, right? So you can 260 is your break even point. So I think kind of understanding that, like at the low end, if something goes south, like I should be able to exit for this is important. And then also,
so think worst case scenario.
Thinking worst case scenario.
And does this still work? Would I still buy this deal if everything went wrong? How protected am I? How hedged am I against risk?
For sure. Yeah. What's my worst case scenario? How likely is that worst case scenario? And can I handle that risk? And then and do I have a secondary exit strategy? Is my credit such that I could go refinance and hold this? And would it make sense to hold it?
Yes. Yeah.
And what does that mean?
Yeah. Can I bail myself out a different way?
Yep.
I've had to look at that as well. Like, hey man, this one's not going too well. Like, do I need to, do I
need to go look at
other options?
Get a DSCR loan or a bank loan or something to just hold on to it.
Which is another really good reason to use hard money for flips rather than bank money. Because if you do need bank money to bail yourself out of a hard money deal that you don't already owe the bank $2 million, they're a lot more likely to give you the money.
That's true.
When you need it.
Yeah. And banks like those, what they call rate and term refinances, where they're just coming in and they're just financing another lender, even that's just a hard money lender like myself. They see that lien on there, they say, okay, we'll do a loan to refinance that.
Cool. Yeah, that's fascinating, man.
I think it's important. Like I have some people say like, I am going to refinance this and keep it as rental. And then their plan for the rehab is put all the rehab on credit cards, right? And so all of a sudden, like your usage ratio goes up because you're maxing out all your cards and your credit tanks.
Right.
then now you can't refinance anymore. So, I remember early on in my investing journey, I was like listening to Dave Ramsey and stuff, and more my financial journey, I guess I would say. And like, he's like, credit's crap, but it's just a matter of fact, a reality of this world that good credit matters, like, and it gives you more flexibility. So you don't need to have great credit to flip houses and things, but if you want to have that exit strategy to refinance and some more flexibility, watching your credit score and that things matters too.
Yeah. And so like a lot of people that I know would like to, flip houses, buy ugly houses, like do the whole investing thing. But they don't have like the cash cushion to like be able to jump in and kind of like, safely avoid that the way that you just described. Like they actually, need the money to pay for the renovation. And so, I've got a lot of people that I'm, allowing them to kind of invest alongside me in some of these deals where like, they're putting their money to work. But I'm kind of their hedge. I am their safety net of like, I do have the capital that I've built up over the years to be able to make sure that we're safe and that we've got what we need to keep everything afloat.
If you find an issue behind the walls or something that needs some extra cash, you can come in and help do that and keep the project going. And
it's there.
Yeah.
Yeah. The money's there if we need it. We're not going to
Yeah.
be swiping our credit cards. And if it comes to it and somebody has to bail us out and buy it with a bank loan, I got us covered there too. If it, God forbid.
Right. Yeah. It's good to have multiple exit strategies. So.
Yeah. 100%. Man, yeah, this has been awesome, man. I appreciate you coming over here and doing this. Like, this has definitely been a really cool conversation. I've learned a lot.
For sure.
And hope we can continue to do lots of business, and hopefully somebody watching this gives you a call and is ready to borrow some hard money.
Yeah, no, thanks for the opportunity. Always good to chat and talk about investing in hard money. Something I love to do. I monthly put on the East Idaho RIA, the Real Estate Investors Association, and it's just a free monthly meetup group where we have people come and talk about investing in things too. So that's kind of where I got my start, is just listening to podcasts, going to meetup groups like that. And so I think networking is just such a huge part of the strategy. Cool.
How do they find RIA?
Yeah, so the best place would probably be on Facebook. If you look up the East Idaho RIA, REIA, we have a Facebook group on there.
Tag that. Cool, man. Well, thank you very much.
Yeah, thanks, Adam.
All right, that was Avery Robertson. That was an awesome conversation. I definitely learned a lot. Hopefully you guys enjoyed that. And if you'd like to have him back, definitely drop your questions for him, and maybe we'll do a follow-up episode. So again, my name's Adam Walz, and this was Buy the Ugly House.